Hello and welcome to Commodity Champions. I'm Manisha Gupta, and a war is raging on between Israeli forces and Hamas militants. The conflict has fueled concerns over the potential impact on the prices of crude oil. As of now, the Brent is holding around $88 a barrel. Neither side is a major oil player, but the markets fear that if the tensions spread beyond Gaza, it could hurt supply from the Middle East, which is a key export region. Another factor that could impact oil prices is Iran's involvement in the Hamas attacks. Any evidence against Iran could lead to more U.S. sanctions on its energy sector. Well, we have seen the prices continue to be quite volatile, but where are the prices headed from here? What is the demand and supply scenarios right now? And what are the worries that an investor and a consuming country like India could be looking at? To discuss and watch all of those in global markets, I am now joined by Vikash Halan. He joins us. He's Associate Managing Director at Moody's. Vikash, hi, thank you so much for joining us. I mean, it has been quite a volatile year for crude oil prices. I mean, I remember we've seen a low of $70. We've seen a high of 96 in the previous month itself. We are trading at around $88 right now with an expectation that you could be going to 100 before this year ends. First of all, on your prices and a view on the kind of volatility that we are dealing with.
Indeed. Look, the oil prices have always been a matter of great concern for the markets, and it's something that has had an impact on financial markets, and geopolitics plays a big role in how the oil prices move. On top of that, we have severe amount of uncertainty so far as demand is concerned. The economic outlook, the growth outlook for the global economy is pretty weak. With interest rates being this high, the China recovery of demand hasn't materialized that we expected post-COVID. So that's, again, an additional sort of downside. That hasn't played out as much as people expected on the oil price, particularly because of stocking that was going on. Now, if that process gets interrupted in China, that will have an impact on the demand. Now, with that backdrop, what happened over the weekend, as tragic as it is, adds to the geopolitical risk. And, as you pointed out, neither of the region itself is not producing any oil, but it can have spillover impact if particularly the conflict broadens and, more players are involved. You mentioned Iraq with Iran, which is a big player, and any sanction on Iran will again move the sentiments, particularly for the oil market, and could have an impact on the supply side. So therefore, what OPEC does after that will again drive the oil prices. So in summary, things are going to be quite volatile as long as this conflict lasts.
So, Vikash, what's your sense on what range are we looking at then for the rest of this year? I mean, I understand it's there's a lot of concerns in the market right now, and it's difficult to predict crude oil prices. But is there a range that Moody's per se is working with?
So we are looking at an $85 per barrel for the rest of the year as an average. Of course, oil prices will be above that, and oil prices will be below that. But 85 as an average seems to be a good number to work with. Our medium-term prices have remained at 55 to 75, so that remains unchanged. Longer term, with the demand, I think going to be underwhelming, demand growth going to be underwhelming over the next couple of years. We might see that there is more downside pressure on oil as opposed to upside pressure. But there is also supply side that is getting quite volatile, I would say, with OPEC cutting down its production, and Russian crude continues to be uncertain in terms of availability. So it's not just the crude oil prices that we are tracking. We are also looking at downstream in terms of refining. We recently had the Russia diesel shipments that got interrupted, that resulted in huge uplift in refining margins. And then if you go further downstream on the chemical side, the picture is even bleaker, because at these oil prices and the demand outlook that we've seen, the chemical spreads have been, multi-year lows. So across the value chain, you've seen different fates for different players, and I suspect that is going to continue. But on oil prices per se, things continue to remain, I would say, on a much firmer ground than we have been since 2014, and $85 that we are working with for the rest of the year seems to be pretty achievable.
Vikash, markets also are looking at China, and we are dealing with some statements coming in that China could be looking at 1 trillion yuan of yet another stimulus measure coming in. If that happens, how much of a support do you see coming in for crude? Because apart from demand and supply, apart from what the OPEC as a cartel is doing, a lot really still seems to be hinging on China.
True, but at the same time, the situation in China is not as clear, that can be solved with a particular amount of stimulus, because, there are some structural issues that needs to be addressed before the demand revives. So it's not just a matter of stimulus. It will certainly help, but the extent of impact will depend on what form that stimulus is in, which industries that stimulus goes to, and what it does to ultimately the demand growth. So it will help, but it's not clear how much, and of course it's not clear whether that will happen.
Well, absolutely. What's your sense also on the OPEC and allies? I mean, we've seen them cut output. We saw Russia do a quick turnaround in sense of gas exports being allowed via port. How are you reading into the cartel's movements now?
As I said, the supply side decisions are much more price supportive than what it has been since 2014. So this is the first time we are seeing OPEC being very firm in trying to get to a price level, and they are willing to cut production, whether that is being held by the sanctions on Russia per se, or whether that is a change in mindset. Only time will tell. Once the situation with Russia gets resolved one way or the other, we will find out what is the look through. But for the time being, the decisions have been quite price supportive from OPEC, and that's why I'm saying the price downside remains fairly low in the mode that OPEC is in now.
Clearly that. So what's your sense on India? I mean, a country which is headed for elections soon. I mean, yes, we immediately may not see a huge fuel price hike here. At some point in time, if the crude prices stay on the higher side, it may be passed on. But what levels do you see India being comfortable with?
We published a report, in fact, at the back end of last week, where we said as long as the crude oil price in itself is about $100, and there is not a significant amount of increase in refining margin, so refining margin remains fairly in line with the historical levels, that should be okay. $100, is something that can be accommodated in the current price for the refiners. So, beyond 100 at a time when you are somewhat hamstrung by elections and you cannot increase prices, that's the time when the refiners will probably be losing money. But that's the situation that, as a base case, as I said, we are working with $85. So it is still, and the prices are pretty much around that. It went up to 96, but now, back to 87, 85. So we still have some room. But if oil prices go above 100, and if the refining margins go, north of $10, $12, that would mean that there would be some pressure to increase prices post-election.
A final question then, Vikash, and this one is on macros yet again, because the higher interest rates, the weak economic data, and the kind of demand concerns that we've seen come in from Europe as well seem to be hurting. What's your sense on how will the interest rate, the currency play on?
I'm not an economist, so I wouldn't venture on where this will land. But our house view is that the interest rates are going to stay high for long. We think that the fiscal, monetary policy will stay where it is now. There is a low probability of another hike by Fed or BOE, but overall, I think the rate increase cycle is done, and but the rate cut will not yet start. There is time for that to happen, and until that happens, the financial conditions will remain tight. Now, therefore, the growth outlook is quite somber, I would say, and it will, while we are not saying that there is going to be a recession, but the growth will be low, and that could have an impact on the credit environment, and we might see an increase in defaults. So overall, I think the environment that we are in is precarious from a credit perspective and ever evolving.
It surely is that, and that makes the prices very, very volatile, especially for the crude oil prices as we see it. Vikash, as always, thank you so much for joining us here at CNBC TV18. We will now take the conversation ahead with Anish Dey, who's Global Head for Energy, Natural Resources and Chemicals, KPMG. Anish, thank you so much for joining us here at CNBC TV18. And first of all, on the kind of volatile moves that we have seen in case of the crude oil prices, the geopolitical tensions clearly keeping it up and high and above. You know, I just want to take a step back, actually. During the Russia-Ukraine conflict, we did see the crude oil prices jump all the way to $120 a barrel. With what's happening between Israel and Palestine, we've seen a knee-jerk reaction, but the crude prices haven't sustained higher.
Yes, because these are not really crude-producing areas. And the hope is that while it's kind of the whole conflict has been more severe than anybody would expect, the hope is that this will be localized and it won't conflagrate into the wider Middle Eastern region. And that's why the crude prices haven't jumped beyond the point and is more or less heading back now. If that is not the case, just in case that it conflicts to other areas, extends to other areas in the region, then that, of course, will be a very, very different story. But the hope and the expectation is that it won't.
I know this is all very gesticulation, but, from where we stand right now, the kind of statements coming in with countries supporting this country or that, what's your sense on how longer could this go on?
See, I think the political problem will go on for a very long time. It's not new, right? It's been there for 100 years now. It started with 1917, if you go to the history of it. And since then, it's gone on for ages now, more than a century. It won't go away. But I do not expect that even if people issue statements, they're going to do something which is silly for the whole global economy or the energy sector.
Anish, depending on who you're speaking to, will tell you that the crude prices are headed to 75 on the lower side, perhaps, because the demand is yet to improve. But with the geopolitics and the fact that OPEC and allies are trying hard to keep the prices firm, we could be looking at $100 a barrel as well. Between this big range, what's your sense on where could the crude prices move?
Actually, given the nature of the commodity and the cartels which exist and the geopolitics which are involved, this is not a very large range. Honestly, I would call the 70 to 90 range a Goldilocks range in that sense, neither too hot nor too cold. It works for both. And it will always, when there's a crisis or a tension, it will go on either side, one way or the other. But I think in between the 75 to 90, or maybe even if you sometimes stretch it to 100, these are things which we can live with. If it goes beyond 100, then there is a challenge.
Everything, whether it's from aviation to fuel prices, to paints, to rubber, chemicals for that matter, wherever the crude is used as a raw material, we've seen all of those prices also gain up. How are you looking at many of these industries with the kind of inflation concerns as well that we're staring at?
I think the biggest concern I have is interest rates, because the interest rates have been high for a while, inflation has been high for a while and sustained. And that is constraining new investments in many of the sectors which are capital intensive. And if that continues, if the interest rates continue to be high globally, then we have a big challenge that we are going to see inflation and stagnation at the same time, because underinvestments and also inflation affecting the quality of life and affordability. So that's my bigger worry, whether the interest rates come down. If the interest rates globally come down, then I think a lot of these things will get taken care of.
For the Indian markets, the plus point perhaps for the near term is that there are elections and you perhaps wouldn't see a very big fuel price rise coming in till then. How do you see India demand growth, one, and the point that for the time being, we may not see a price hike, but it has to be passed on at some point in time?
If it's in the, say, $70, $80 range, then it's all tolerable. The Indian economy is large enough to, even sustain $90 so without major price hikes and without a major damage to the fisc. So if that is the range, then I think we are okay. But the moment it starts crossing that range, then we are going to see, inevitably see price hikes, but that's at least 7 to 8 months away.
Sure is. India's Energy Minister, Minister Puri, for that matter, has been saying for some time now about and has recently again talked about the India biofuel or Global Biofuel Alliance. How do you read into that, the whole idea about energy transition, the kind of work that is being done to ensure that India's dependence on producing countries not so much, and the kind of knee-jerk reactions that the crude prices see, and India also it tends to get impacted because of?
Yes. So I think we have no alternative because we are almost importing 90% of our crude. So if we have to really sustain ourselves, we need to look at alternatives. So electricity through solar, wind, and renewables in general was the first step towards that. But when it comes to liquid fuels, having to look at biofuels is an obvious step. The challenge is that it's not because it's not obvious, but it's only because it's so hard to get the whole biofuels ecosystem working. But I think we're making some advances in that. The whole thing is coming. The ethanol story is a great story which has come together. Other biofuels are also going to come in. Hopefully, compressed biogas is going to come together. So now it is time for India to kind of scale up this and look at this becoming a global imprint from the country and the whole technology ecosystem and everything coming together. So I think it's very timely. It has always been a solution, but we haven't been able to crack it. I think we are getting to cracking it now.
So also, Anish, how are you looking at the kind of investments that India is making, whether it's by ourselves or partner countries or other different countries? What is the kind of investment scenario that we stand into right now? Are we moving right towards the timelines and deadlines that we put for ourselves? And what is it that India will need to invest to get to energy transition, let's say by 2030 or 47?
So if you look at the numbers which we are talking about, globally 4.5 trillion per annum, which is a very, very large amount. So it's a sudden jump which is required. But I think the world can find, as long as that capital can find a return. So that is okay. And for India, it's a sweet spot because we're going to require about 10% of that, which is about 450 billion per year. And that is something which we can do because India, as I mentioned, is quite a magnet for investments now. So I don't see a challenge in that, and there's a need for sure because the demand exists. So that part is the project development story, and that helps in the energy security and various other benefits come along with it, co-benefits come along with it. But I think the manufacturing story is very interesting because that in aggregate by 2030, in the next 7-8 years, is going to require about another 350 to 400 billion in investments through the renewables value chain. And that's where India can go several notches up in the life and the whole value chain as compared to being just a user nation or a consumer nation. So I think that is a great opportunity. Associated with that is a skills opportunity, which is again very large. We're talking about really, really large numbers in terms of employment, which is what makes it very attractive as a policy target, the whole energy transition.
All right, so if Moody believes that the crude oil prices can trade within that 55 to 75 mark with 85 as a near-term average, KPMG believes that 75 to 95 could be that broad range that the crude prices could be looking at for the rest of this year. Thank you so much, Anish, for joining us at CNBC-TV18. With that, we'll go for a short break, but don't go anywhere because as we return, we'll talk about the latest NSE launches with Sriram Krishnan, who's the Chief Business Development Officer at NSE.